look at the past decade, growth stocks clearly led the market. You can look at many software companies, many large cap companies that fall in the growth category, and for the past decade they had very solid returns. If you look at 2022, growth companies actually have a problem. They're seeing slowing revenue growth, but at the same time they're increasing operating expenses to try and drive revenue growth. So what we see in the marketplace today is slowing revenue with higher operating expenses. And if you look at that combination, that's typically not a good combination for growth stocks. Now, this isn't all growth companies, but there is some growth companies that fit in that category. In addition, what we see in the marketplace today is investors don't want companies that lose money. They want companies that generate operating profits, have operating cash flow, and many high growth companies don't fit that profile. So it's very difficult for us to answer that question as far as when will growth stocks outperform. But what's very interesting to us is the convertible asset class actually has a lot of companies that issue convertibles. And many of these companies have convertible bonds that trade closer to their bond floor, yet there's still upside optionality. So when we're looking at the growth market, in fact, we see the best opportunity to invest in growth companies is through the convertible asset class. Because if you're investing in a growth company through a convertible bond, you have that upside participation, but you also have that downside cushioning because again, we cannot time markets as investors, but right now the outlook that we see for growth companies remains uncertain. Historically, when we look at the convertible asset class, you can see that over full market cycles, and this isn't quarters or years, this is years and decades, that the convertible asset class delivers equity-like returns with less volatility. In 2022, the convertible asset class is down similar to the S&P. The asset class has been impacted by two things. First, growth has underperformed the broad market, and the convertible asset class tends to have more growthier companies. So the underlying equity of the convertible market has underperformed the S&P. The second aspect of the convertible asset class is credit spread widening. We've seen spread widening in investment grade bonds and in high yield bonds. Likewise, the widening of those asset classes has also spread to the convertible asset class. So what we've seen year to date in 2022 is the combination of equity drawdown with credit spread widening, and that's why the convertible asset class hasn't provided as much downside protection as one would imagine in a short time period. However, the long-term relationship still holds. If we look at how the convertible asset class has done since the start of COVID, it's done exactly that. It's provided inline participation with the broad equity markets while offering downside protection. When we look at the forward returns of the convertible asset class, the convertible asset class today is a little more bond-like or busted because of the sell-off of the market. That means it's possible that the downside protection should be greater than what has happened so far in 2022, but more importantly, since there's still a lot of time value left, that upside participation still exists. So if we look back at the historical norms of how the asset class performs in periods of drawdown, there's no reason to believe that this cycle for convertible performance should be any different from cycles that we've seen in the past.
Allianz Global Investors.